Welcome to another episode of the Global Investors Podcast. I'm your host, Charles Crillo. Today we have Marco Pfeiffer. After immigrating to the U.S. at a young age, he built a portfolio of 40 rental properties across Florida, Georgia, Alabama, and Mississippi, and he retired from corporate life at 45. Today, Marco specializes in facilitating commercial loans that help businesses achieve their property goals, and his approach is grounded in years of hands-on experience, primarily in the fix and rent strategy. So Marco, thank you so much for coming on the show today.
Hey, Charles, thanks for having me. Appreciate it.
So you have an interesting background immigrating to the United States from Germany, and then also having a W-2 and getting out of that W-2, which I think is a goal of a lot of people that try to get into real estate. So can you tell us a little bit more about yourself personally and professionally prior to getting into investing in real estate?
Yeah, so born and raised in Germany. I was 26 years old when I came to the US. Came alone, never been to the US before. My English was awful, and didn't know anybody in the US. The only thing I had a contract with a German company who was looking for a German financial analyst to help them with the integration of a US operation that they bought with a reporting to Germany. So that's how I ended up in the US. Ultimately, this company went bankrupt, but I decided to stay in the US and had a corporate career from financial analyst to internal auditor to controller to ultimately becoming chief financial officer. Was a chief financial officer for about 10 years. And then along the way, I discovered real estate, initially single family. The pivoting point was when I was in 2016, I lost my then job as a CFO. Had this wake up moment like, hey, there's no cash coming in. I mean, I was okay. I mean, we had some money saved, obviously. I had a good salary. But I realized how dependent I was on W-2. And looking back in hindsight, it was a blessing in disguise. So for 3 months, I went all into real estate, learning, going to meetups, going to conferences, getting coaching, and went back to work, corporate job. But I started buying single families. So, and I looked at strictly for cash flow initially. I wanted to have like $3,000-$4,000 in cash flow coming in. So the idea was if I ever get unemployed again, I still have $4,000 coming in. That's going to cover my basic expenses. So this was 2016. Inflation was not as bad. And then what happened was the snowball effect. So basically you start with one. I used the good old BRRRR strategy. So I bought properties, got them fixed up, raised the value, refinanced them, still cash flowed on them, and basically recycled the money and bought more properties. So my assets paid for my assets. By 2020, I had about 23 rental properties. I was flipping a few houses. Along the way, I also got into multifamily, so I had a 12-plex at the time. And I was making more money in real estate than in my corporate CFO job, and decided to retire from the corporate life. This was September 2020. And since then, I scaled up to 150 apartment units in a joint venture with the business partners, ultimately sold them in 2020. And I still do single family rentals. So right now I have a portfolio of about 45 single family rental properties.
Right. And so they're in all different states. When you were starting out, you had a W-2, you were buying properties. Can you tell us a little bit about how you were managing those properties? I mean, because you're managing renovations. We're not just buying turnkey properties. So can you talk a little bit about how you set it up with what markets you used and how you were able to manage it while having a W-2 and do the renovations?
Initially, I invested where I lived. So I lived in Houston, Texas. When I lost the job, my next job after that was in Huntsville, Alabama. So I started buying property in Huntsville. What's a little bit unique is from fairly early, I started investing out of state. So I come to Fort Myers, Naples area since 2011 for vacation, and thought it was a good idea to buy properties here, to have like a property out of state. I also love the market. I was very bullish on the market. And from a tax perspective, it was a write-off. So I figured whenever I come here for vacation, now it's going to be a write-off. And I started investing here. I had a good network. I knew a bunch of people. And I found some good contractors, and I was able to manage a remote. So I learned to manage remotely. So learning remotely means um, basically monitoring the contractors, setting clear expectations, setting clear timelines. Um, Initially, I used a property manager. Later on, I started self-managing properties. But also, a lot of it came through when I renovate homes. I mean, they look like you could sell them. They like a flipper would do it. And so I address many of the issues up front in terms of maintenance. And by doing that, I mitigate the risk of maintenance issues along the way.
Yeah. So you said when you got into it, your goal was to make $4,000 a month. Obviously, this is like 10 years ago. But can you explain how your kind of investment goals and your strategy really progressed to becoming a full-time investor and eventually leaving your W-2? Because it sounds like you got into multifamily, but you're back now fully in single families.
Yeah, I mean, so single family, it was basically every house $300 to $500 in cash flow. So my goal was initially 4,000, or that meant I needed about 10 houses more or less. And then, like I said, the snowball effect kicked in. So, okay, I did 10. I can continue doing this. I figured out to do that while I was still working. Obviously, it was hard. I worked 50, 60 hours a week in my regular job, but then the evenings and the weekends were for real estate. And I think that's a lot of people that they look at once in a while. I encounter people like, oh, you have all these houses and all that. I mean, it's hard, especially if you're in a W-2. But I always would recommend people to build that cash flow while they have a regular job, because there's way too many people there. Surprisingly get laid off. Like, oh, what I'm going to do now? I think you have to prepare for that moment while you're still working. And then when I got to this number of like, okay, I can keep doing this. I mean, I got 10, 12, 14. It's this process, And like I said, I come into multifamily. So I found a good business partner. We did a joint venture. We didn't do syndications, and we started buying 40, 50 unit apartment buildings, and basically the same thing: fix them up, get them rented, get the occupancy up, and then ultimately in 2022 we decided to sell them. We felt like where the interest rates were going, we kind of hit the peak of the market. Usually I'm very bad in timing, let's say of stocks or anything like that, but this one actually we timed perfectly. The last one we sold in September 2022. And a lot of the proceeds, I bought additional properties, and so I just do the single family for now. I will get back to multifamily at one point. I just haven't found the right opportunity. There's just a lot of noise in multifamily right now, so I just kind of wait for the water a little bit to calm.
So how do you handle property management on your current portfolio? Because I mean, you're over 4 different markets, 4 different states.
It's a mix between property manager and self-managing.
Okay.
It's about half-half. Property manager, I think one of the biggest challenges in this business is finding a good contractor and finding a good property manager. So over the years, I've hired and fired well over a dozen property manager. It's I mean, just in general, nobody loves your house, nobody loves your asset like you do, So if I give my house to a property manager who manages 400 other houses or manages 2,000 other units, I'm just one of many, and some are more interested in how the investor performs, and some are just doing their job, and so it's finding good property managers. It's a big challenge.
How did you find those property managers? Because for multifamily, when we're finding property managers, the best ones I've found is from other local investors that are in the same property, like class type, size, pretty much like the same properties I'm buying. Speak to them and they give you, and everything is good. Anybody you can get from them is very good. Agents and brokers, not as great. But how do you find it with like single family? Because what I found in single family, or when I was looking, if I go into a new market and you're searching for property managers, I usually would find like part-time real estate agents / property managers that are doing like vacation homes. And I mean, how do you find a good single family property manager?
Yeah, those are the worst. I mean, no offense to real estate agents or real estate brokerages, but they're by far the worst property managers. Um, would never, anybody who ever gets in single family or wants to build a portfolio, never ever use a brokerage or a real estate agent as your property manager. It's just not their business. You just don't know. They're just not good at it. Similar to what you just described, talk to other investors, find other single family investors, and sometimes it's just trial and error. So I invest in Mobile, Alabama. In 2020 I bought 4 turnkey properties. So somebody renovated them, fixed them, put a tenant in, and then sold them with a tenant in it. So I used that company. Turned out they were not as good as I thought they would be, and you just move on, or you start self-managing. The other thing I learned is how to self-manage. So especially if you have a newer home where there's less maintenance issues. I've done some build to rent where I have brand new homes. It's just you have less issues, and in this case, if you put the right process in place, if you have the right tools, you can also self-manage. Obviously, multifamily is different, so I would not recommend self-manage anybody in anything multifamily. In single family, I think self-managing is an option if it's the right asset, the right type of property.
Yeah, I think also in single family, the benefit that will always be over multifamily, for the most part, I mean, maybe now it's a little different, but or maybe it's longer for both. I think you just have less turnover, and think you can spend a little bit more time vetting people and getting them in there and finding someone that's going to spend not just your 12, 24, 36, but maybe like 4 years plus in there. And I think that's like the whole benefit. And there's more of a pride of living ownership with someone in a single family versus, especially if you get their kids into the schools and everything like that. I mean, it's just, these are all these factors.
Yeah, I would fully agree. Like I said, I own apartment buildings as well. So it's a different type of tenant in general. I mean, there's some overlap obviously, but in general, I mean, I have houses. I still have the same tenant from when I bought it 5, 6, 7 years ago. So you rarely find that in it's more transitory in a multifamily, and but yeah, it's a different type.
Yeah, my first couple multifamily properties were in like small 3-family type properties, and you still had a almost like a single family feeling to that because you have the backyard, driveway, pretty much all to yourself. And I had tenants in there for 10 plus years, you know what I mean? When I sold them, you know what I mean? So it was, you get stickiness in these type of situations that are a single family or very close to a single family type experience for your tenants, I found.
Do you have money sitting in the stock market and you're worried about it? Or worse, you have money sitting at the bank, not keeping up with inflation? My name is Charles Carrillo, founder and managing partner of Harborside Partners. And since 2006, I've been investing my money and my family's money into income-producing properties. These are real assets, real properties with real addresses that produce real cash flow. At Harborside Partners, we provide passive investors who love real estate with a turnkey investing solution. If you want to put your money to work in real estate but can't find deals, don't have the time to get funding, and the last thing that productive people want to do is manage real estate. We find the deals, we fund the deals, and we manage the tenants, the termites, and the properties. Partner with us at investwithharborside.com. That's investwithharborside.com. Go to investwithharborside.com. If you love real estate, you like the idea of passive income, and believe that income-producing properties will appreciate over time, go to investwithharborside.com. That's investwithharborside.com.
So let's talk about your company, Opportunistic Capital Group, and kind of what you guys do and how you guys assist investors with placing them with loans and everything else.
Yeah, I mean, basically, my main business is still the rental property. My main source of income, my main focus is the rental. But however, I slowed down. I'm not as active anymore. I actually sold a few assets in the single family space. When I see the right opportunity, I buy one. And then along the way, I had a lot of investors. I'm very active on LinkedIn, so I post about some of the deals I do, some of the things. I post about my story. I think a lot of people on LinkedIn can relate to that story of working a corporate job, feeling the being on the hamster wheel, doing the same thing over and over, sitting in endless meetings, but having these golden handcuffs. So you have a mortgage, especially with kids. You have a mortgage. You have a car note, your lifestyle usually as you get promoted or as you rise in the ranks in the corporate world, usually your lifestyle and your expenses go up with it. You get a bigger house, you get a nicer house, you get a nicer car, you get more vacation, longer vacations whatsoever. And I think a lot of people can relate to that story. And obviously, I know other investors. I built some good connections with private lenders. So in residential, you have two options. One is the regular, the Fannie Mae mortgages. So usually it goes with a bank or Wells Fargo, Chase, something like that. But there's also a growing market and has grown substantially is commercial loans for single family. About 10, 15 years ago, that market really didn't exist. And what's kind of Blackstone opened the door for that when they start buying 50,000 single family homes. Nobody ever, because one of the downside about single family, what you hear especially from multifamily is like you cannot scale up in single family, which is true to some extent. However, Blackstone kind of made the case when they bought 50,000 houses. You can, if you put the right processes and the right focus on it. And if you have the financial resources. And so that more institutional investors, more even investors like me trying to scale up, it became more interested for the commercial lending space. So what I started using is what's called DSCR loans, debt service coverage ratio loans, which are still 30-year mortgages, just a commercial. They're in an LLC. They're not my personal. I couldn't even get a personal mortgage anymore. I wouldn't qualify for it.
W-2, right?
Yeah, no W-2. I think you can have max 10 houses, and then you cannot qualify anymore. And through that, I built these connections. These lenders like me. They know I perform. They know there's never a late payment. They know whatever. Usually I'm pretty good when it comes to estimating the ratio, whatever the rent versus so I built some strong connections. People on LinkedIn, other investors reach out to me. So, hey, I'm trying to get financing. I cannot get financing. So I start connecting the two. So a lot of those private lenders are hedge funds or for financial arms of private equity firms like Blackstone has a mortgage operation, and then I have these investors that reach out to me and say, hey, I need some help. I have a flip. I have a house that needs to be refinanced and things like that. So try to connect the two.
Yeah, one thing you mentioned earlier about people, you suggesting people start building a portfolio while they're working, and one of the things that major part of that is obviously if you're buying 1 to 4 unit properties, the financing is so much easier. And I think it pushes people into the 5+ unit commercial, let's just say multifamily realm, because the financing completely is like a 180. And it's much easier. Yes, you have to have a solid down payment. In most situations, you can always work out deals with certain banks, but for the most part, they're going to be looking more at your asset, the property, versus Marco, the borrower type person. And that becomes, I think, a little easier. Now, let's talk about what you're buying now. So interest rates are down a little bit, but they're still, we're still high. Historically over the last several years, let's say. How is you're using DSCR loans, which as I understand with those are heavy down payments. They're probably going to have a higher interest rate than a typical FHA. Is that correct? Like for an investment loan? Tell us a little bit more about what you're doing.
It used to be a point difference. So if the FHA 30-year mortgage was 5, the DSCR is 6, but that actually came down. So that gap, it's maybe like a half point now. Difference FHA versus DSCR. Now, obviously, it depends on the deal. It depends on how much is your debt service ratio. Is it 1.0? Is it 1.3? There's a lot of factors going into it. But in general, it's DSCR is 20 to 25% down payment. And it's just much easier. It's not, I don't have to provide tax returns. I don't have to do, it's very similar to a multifamily, commercial loan, so that helps definitely is makes the process much easier. And from what I look for, what I buy, I did this house this year, built 2 houses, kind of built to rent model. I found a builder where I could kind of cost plus deal, which worked out pretty good. So I had some initial equity, substantial equity in the houses right after they were built. That's one of my focuses, and still, like I said, if I really see a good opportunity where I feel there's a strong cash flow, my focus has shifted a little bit. I used to buy a lot of nicer B homes. That means they were renting for like $2,200 in the markets I'm in Alabama or in Mississippi. So $2,200, $2,300 homes. They're really nice homes. But I kind of shifted that focus. What I noticed that the homes with higher rent sit longer. 2-3 years ago, I had a home for $2,200 in Mississippi, which is on the higher end in the markets I'm in, and that was rented within 5 days. That same house is sitting now for $2,100 or $2,000 sitting for a month. So I shifted my focus more into the $1,600, $1,700, $1,800 rent houses, and those I still buy.
Nice. Okay. So what would be kind of some of your advice other than people starting out earlier than later, which I think everybody that I speak to as a real estate investor, kind of what they say, but what would be some other common mistakes maybe you see on the other end of this? Real estate investors that want to start building a portfolio, and when they're buying properties or any part of the purchasing or managing process, where do you think most real estate investors, or where the largest number of mistakes are made?
I think the first one, just want to address what you just did with the age. I think a lot of people consider age a problem. I get messages on LinkedIn all the time, or comments. Oh, I'm 55 already. I wish I had learned this 10 years ago. I wish I'd learned it 50 years ago. I feel it's still possible. I know I coach. Sometimes I coach people. People reach out to me and coach me. I coached a guy who's 57, and he bought within 2 years 3 years about 10 rental properties. So the age is obviously, yes. I started when I was 40. I wish I'd started when I was 20. Absolutely, but I think it's still possible. I think one of the issues, people should not have their age hold them back. That's one thing. And I think the biggest issue I see is the analysis paralysis trap, where people analyze and then they have these elaborate models, especially for single family. I understand in multifamily, it's a different kind of, it's a different valuation, different ways. I understand you have some more elaborate models. I was a CFO, so I fully understand IRR, cash flow models, predictions, whatsoever. I don't really think you need that in single family. And I think a lot of people are like, oh, I need to account for vacancy. I need to account for this. I need to account for that. And if you account for enough things, then every deal looks shit, So, so I think that the analysis paralysis is just not a good time. Oh, real estate prices are too high. I'm going to wait until prices come down. Then prices come down. Oh, I think they're going to come down more, and then prices pick up again. They picked up again, but they're going to come down again. It's just people always find a reason not to buy. And then you look back. I started in 2016. I remember in 2016, one of the people I went to meetups, there was one guy, he was teaching a lot, and he sold his entire portfolio. He had about 30 houses. He sold them all in 2016 because he was convinced that the market went up so much since the financial crisis. It has to correct. And then when it corrects, he has all this money and he's going to buy it all up. That was his strategy. Well, he's probably still waiting, So it's hard to time the market. And then every time, whenever you buy and you look back 10 years ago or 10 years out, it turns out to be still a good deal. Anybody who want me in 2020, I shouldn't buy anything because of COVID or whatsoever. Well, anything I bought in 2020 performed very well. So I think that analysis paralysis, and yes, it can be sick. Multifamily is struggling right now a little bit. Single family at one point will struggle. But if you have a long enough time horizon, I think ultimately it's going to work out.
Yeah, this old school real estate investor told me many years ago that I kind of coined it as a 10-year law of real estate investing. But really, if you're holding a property, make sure you purchase it and you could hold it for 10 years. Because in 10 years, any mistakes you've made with it, they're going to be kind of washed out. You're going to make money on the property. The problem is where people, for lack of a better word, get cute and they're trying to do stuff that's like 3 years and 2 years, and they're using all these aggressive financing strategies, and that's the people that get wiped out. It's very rare that you'll speak to someone that was like, oh, I was on long-term debt that was fixed and I had a reserve fund and it was cash flowing and I lost all my properties. It doesn't happen. So it's really like, that's kind of what I've learned. It's like, yeah.
And that's what happened. All these investors were wiped out was because they were highly leveraged and they didn't have any reserves, and you do a lot of terrible interest rates, so, and it just got wiped out. And I learned that in my very first rental property, I was an accidental landlord. I bought a property in Huntsville, Alabama for $180,000. 1 year later, I was promoted for another job. I left Huntsville, moved to Louisiana, and I didn't know anything. Unfortunately, I didn't know anything about real estate, and I didn't buy a second after that for like 5-6 years. But that one, my agent told me, hey, you can turn this a rental. And I was like, okay. And at the time, my rental was like, my mortgage was like all in $1,150, and I could rent for like $1,200. And I was like, oh, wow, somebody's going to pay my mortgage. So I was very naive in this thing. However, somebody paid my mortgage. That house dropped about in June 2008. So if you pick the worst months possible to buy a house, I mean, June 2008 is probably right up there. And that house dropped to, you could buy houses next door for like $135 in 2010. That house got appraised in 2 years ago for $320,000. So, and it was rented the entire time. It's in a great location. It's 2010. It was vacant maybe 15 days, the house. It's been their long-term tenants. I have people in there the first tenant lived there for 6 years, the second for like 4 years. So, I learned that. Like I learned firsthand, if you just have a long enough vision, and if you're not hurting, yes, it dropped to 130, but I didn't have to sell. I still had my income. My mortgage was covered. I didn't have to sell. And if you just have a long enough time horizon, things will even out.
Yeah, I mean, really the value of property only matters when you're buying, selling, or refinancing. And if it's outside of those 3 times, those milestones in the lifetime of that property, it doesn't really matter much. You know what I mean? And the good thing is that when you're getting into investment properties, it's more and more difficult to value them. You can't just go on Zillow and type in something per se. You know what I mean? So it's actually better for investors because it's not like checking stock quotes. You know what I mean? It's something where you're like, I guess it's this. I don't really know. And that's great. So I'm back to my regular life as this thing just kind of putters along. So,
and I think, actually like multifamily, I think it's a good example. I think there was a lot of noise. I think it's calming down now, and probably people who bought stuff in 24 and 25 will look at it back in 5 years from now and feel pretty good about what they have. But the moment right now, I probably don't see any appreciation. It's like, got to make the cash flow and whatsoever. But I feel pretty strong in 4 or 5 years from now. It should be anything you buy, anything. What cash flows now will definitely cash flow in 4 or 5 years and have some nice appreciation.
Yeah, that's the benefit, is that you can refinance it down the road. I just feel like even if people bought stuff at the top of the market in 21, 22, if they're good properties, so like solid C, B class properties, not in war zone type stuff that don't really go up, which are always kind of a mess, and selling them is not a mess too, not just managing them. If 5, 6, 7, 8 years down the road, you're going to be in a very good position. It's really just making sure when you buy, you have all your ducks in a row where you can hold on to this property for several years. You know what I mean? And I think that's what most investors miss. And investors getting in 22 thought they're going to see rent increases like 21, and it just went pretty much stagnant. You know what I mean? And people's performers weren't like that. So, and they thought that interest rates were going to stay somewhat around the same. They didn't know it was going to go up so high. So a lot of factors you can't control, but you could have controlled, or there's ways of doing it where, but that's a thing where you might have new investors that are already out of the business. You know what I mean?
Yeah, and I mean, unfortunately, there's several assets in multifamily that were foreclosed on, or the keys were handed to the lender in the last 2-3 years, and those are the ones usually bought in 21, 22. Arguably, they probably overpaid to some extent, and had like bridge loans for 2 years or something like this. Those are the ones that really struggling. Anything you bought in 22 with a long-term debt, I think you're still going to be okay.
Yeah. So Marco, thank you so much for coming on. How can our listeners learn more about you, your business, kind of your investments? You said you're very active on LinkedIn.
Yeah. That's probably the best way to find me is on LinkedIn, Marco, Marco Pfeiffer, Pfeiffer. Very active, post daily, post about real estate, but also post about economy, post about my favorite subject, taxes. And feel free to reach out, send me a message. If you hear this podcast, you have any questions, feel free to send me a message there or connect with me on LinkedIn.
Awesome. We'll put your website and your LinkedIn address in the show notes. So thank you so much for coming on today.
Great to be on there. Thank you so much.
Talk to you soon.
Hi guys, it's Charles from the Global Investors Podcast. I hope you enjoyed the show. If you're interested in getting involved with real estate, but you don't know where to begin, set up a free 30-minute strategy call with me at schedulecharles.com. That's schedulecharles.com. Thank you.
Nothing in this episode should be considered specific, personal, or professional advice. Any investment opportunities mentioned on this podcast are limited to accredited investors. Any investments will only be made with proper disclosure, subscription documentation, and are subject to all applicable laws. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Syndication Superstars, LLC exclusively.